We're going to trace how Wall Street turned soil into a ticker, why prices decoupled from crops, and how that can crash your grocery bill. Control the land, control the food chain. The new landlords don't wear boots. They wear fees. Pension funds, farmland REITs, private equity vehicles, and billionaire family offices buy parcels by the 1,000 acres and talk in portfolio terms. Diversification, duration, cap rates. The language shifted first. People used to ask about rainfall and soil tilth. Now it's yield on capital, quarterly distributions, and geographic exposure. On earnings calls, farmland is a line item between warehouses and data centers. The crop is cash flow. On paper, it sounds prudent. Spread parcels across regions. Mix row crops with specialty orchards. Secure rents with multi-year leases. Harvest stability. But listen at the farm gate, and you'll hear the rub. The leases are shorter, the rents higher, and the flexibility thinner. A bad weather year that used to mean renegotiation now triggers a clause. Payment dashboards flag variance. The letter arrives. Due to performance metrics, we're terminating at season's end. This is the quiet reordering. Livelihoods ride the volatility. Landlords collect the stability. The farmer takes the weather, water, and input risk. The owner earns the dividend. The gap between them widens every time capital flows faster than rain. Meanwhile, concentration builds. A handful of public REITs assemble hundreds of parcels. Family offices stitch together contiguous blocks behind LLCs. Institutional managers raise real asset funds that pair farms with timber, water rights, and renewable leases. The pitch is simple: uncorrelated returns, inflation protection, limited supply. They're not making more land. It rhymes with an older slogan that once floated housing. What nobody talks about up front is the decoupling. In region after region, land prices climb faster than farm income. Rents follow valuations, not yields. Capitalization rates fall, even when per-acre profits stall. You see it in auction rooms where sales comps whisper to the next appraisal and the next loan. You see it in local banks quietly resetting credit lines off inflated comparables because everyone else did. And you hear it in farmer meetings where the only way to pencil rent is pushing for higher output with higher inputs: fertilizer, water, chemicals, chasing marginal yield on thinner margins. Control the land, and you don't just control the harvest, you control the choices upstream and down. Seed companies tie contracts to volume expectations. Processors prefer predictable throughput. Retailers want uniform product on schedule. The lease becomes a lever that pushes cropping decisions toward financial targets. Long rotations get shortened. Soil health practices lose out to seasons that can be modeled. Cover crops give way to continuous corn. Orchards planted for 20-year horizons switch hands on 5-year rent escalators. The clock speeds up. The ground is asked to keep pace. Meanwhile, something else is happening in the background. Retirement money, the kind meant to be dull and dependable, is hunting yield in a world of low rates and restless markets. Real assets feel safe. Farmland sits atop that list with glossy charts showing smooth historical lines. The fee structures reward asset growth over patience. Managers gather acres because AUM pays today, soil health pays later. In that calculus, longer leases tied to regenerative metrics lose to shorter leases with ratchets and CPI adders. Stability is engineered at the top and squeezed from the bottom. A microstory: an almond grower in the Central Valley misses a rent step-up after a heat wave knocks production. The fund's model expects rising cash yield. A performance variance triggers a review. The grower proposes a soil moisture investment and a 2-year rent freeze to recover. The lease template doesn't allow it. By harvest, the parcel is reassigned to a larger operator who accepts higher rent and promises aggressive yield via more water. The risk shifts to the aquifer. The spreadsheet stays whole. From the grocery aisle, this sounds distant, but the price you pay is downstream of these contracts. When rents escalate, operators pass costs into bids for inputs and into the prices they must take from processors. When flexibility shrinks, farms can't pivot away from stressed crops, so supply shocks hit harder. When ownership consolidates, regional failures amplify because the same financial terms sit on many fields at once. All of this feeds a larger open loop. Land prices drifting away from the income that land can produce. It doesn't snap in a single moment. It stretches, season after season, as stories of appreciation justify more buying, and more buying validates higher appraisals. confidence stacks on confidence. To understand how that loop formed and why it's so stubborn, we need to go back to the last time an essential asset was repackaged as a safe, tradable instrument. We've seen what happens when use value, shelter, or in this case, food, gets subordinated to financial yield. The mechanics didn't start on a farm. They started in a mortgage office. The 2008 Playbook reappears in dirt. The rewind takes us to a familiar place. A simple asset turned into complex paper. In housing, mortgages became MBS. In farmland, acreage becomes shares in REITs, units in private partnerships, slices in index funds. The promise is the same: safe income, low volatility, diversification. And the engine underneath is leverage rising on the back of rising appraisals. Here's how the ladder forms. A fund buys 5,000 acres. Appraisals tick up because other funds just paid more down the road. The portfolio's net asset value rises. That higher NAV supports a bigger credit line. The fund borrows against the appreciated land to buy more land. Each purchase prints a new comparable that raises the next appraisal. It feels like disciplined diversification. It behaves like self-referential price discovery. This is the moment everything changed in housing too, when use value lost the steering wheel. On paper, risk is dispersed. Corn in the Midwest, almonds in California, berries in Florida. But the real exposures rhyme: rainfall patterns that sink across regions, input costs that move with global energy, commodity prices that slump together when demand weakens. Diversification looks elegant in a deck. Concentration hides in the weather and the water. Meanwhile, the slogans carry the psychology. They're not making more land, inherits the job real estate always goes up once did. It isn't a data point, it's a story that invites capital to ignore income. In the early 2000s, homeowners became collateral. Today, farmers renting land are the shock absorbers. If yields drop, rent still climbs because rent chases valuation. If margins compress, lease churn replaces relief. The stabilizer bar in this system isn't forgiveness, it's replacement. Watch the product menu expand once price detaches from use. Public farmland REITs promise dividends from seasonal rents. Private funds promise total return from appreciation plus cash flow. ETFs track farmland indices constructed from appraisals and transactions that earlier funds influenced. Crowdfunding platforms fractionalize deeds, offering access to the asset class. Tokens appear, granting tradable exposure to a parcel the buyer will never visit. Paper multiplies faster than crops. The safety story leans on history. Charts of farmland returns that look smooth next to stocks. The smoothness is a function of appraisal-based valuation, not minute-by-minute price discovery. That's comfortable in calm years and dangerous when liquidity is needed. In 2008, securitized housing promised stability through aggregation. The risk, pooled and sliced, got bigger than anyone's arms. Here, the pool is smaller, but the spiral rhymes. Income lags valuation, confidence stacks on confidence. Here's a micro scene that explains the mechanics. A regional lender extends a line to a farmland partnership using recent auction comps as collateral support. The comps came from two funds bidding against each other with low-cost debt. 6 months later, rates move up and input prices bite. The partnership's debt service coverage thins. To protect covenants, they push rent across the portfolio and list a non-core parcel. The parcel sells lower than the last comp. The lender tightens advance rates. Now every acquisition model needs a higher rent to pencil. The loop tightens around the operator, but the headline still says agricultural alpha. Paper diversification cracks under synchronized shocks. A drought band can stretch across multiple states. A trade policy shift can collapse prices across grains. When those shocks hit, the REIT still files a dividend, but it's financed by selling a tract or drawing on credit while waiting for appraisals to catch up. That's the quiet mismatch between quarterly promises and seasonal reality. Another echo is moral hazard. In housing, originators earn fees up front and pass the loan along. In farmland, managers earn management fees on assets under management, plus performance fees on appreciation. The incentive points toward gathering acres and marking them higher, not toward anchoring rents to farm income or extending long leases tied to soil metrics. If fundamentals wobble, the parcel can be sold to the next buyer who believes the chart. There's a claim that farmland isn't as leveraged as housing was. That's true on balance sheet for now, but exposure is leverage too. Pension funds counting on a steady 6 to 8% real asset sleeve can't afford a flat line. If price appreciation stalls, redemptions tug at open-ended vehicles. To meet withdrawals, funds sell into a thinner bid. Discounts show up. Appraisals chase prints down, and bank covenants start whispering. The fragility isn't only debt service, it's promise service. What nobody knew in the early innings was how quickly financial products would outrun agronomy. The lease template shrank the planting horizon. The dashboard turned weather into variance. The index turned land into a number. Once that translation happens, the same gears that spun in 2008 begin to turn in soil. The trigger isn't mysterious. A rate spike, a commodity slump, a cluster of droughts, or redemption gates pulling liquidity out of stable funds. To see where it leads, follow the incentives. If a parcel throws off less rent than modeled, raise rent or rotate tenants. If the model misses appreciation, borrow less and buy fewer acres, or more often, sell something to hit targets. Every action is rational inside the fund and heavy outside the fence. The farmer shoulders the variability. The system, for a while, looks fine. This is the echo we're living through, familiar architecture wearing different boots. And once new paper can be printed on land, more paper will be printed. Slicing the soil, REITs, funds, ETFs, tokens. Once price detached from use, products multiplied. The first cut was the Farmland RE. It looks simple. A company owns fields, leases them to operators, and pays shareholders dividends from seasonal rent. On earnings calls, executives walk through portfolio composition. Almonds here, berries there, corn and soy in the Midwest. Then showcase dividend coverage like they're discussing apartments. The calendar is agricultural, but the cadence is financial. Rents land in quarters. Guidance sets the tone. The soil becomes the substrate for yield. Inside the REIT model, seasons are smoothed. A drought in one county is offset by an orchard harvest in another. That smoothing is the selling point. Investors aren't betting on a single farmer's year. They're buying the idea that farms, averaged, behave like a slow, reliable bond. Meanwhile, portfolio cosmetics matter. Swapping a marginal parcel for a core, tract upgrades the slide deck, even if the farmer on the ground loses a long lease. The quarter wins. The rotation shortens. Private funds take the next slice. Limited partners commit capital to multi-year vehicles promising total return, appreciation plus rent. The pitch decks are polished. Low volatility charts, inflation hedges, correlations near zero. Managers lay out pipeline maps of target counties, cap rate assumptions, exit strategies. Fees ride on assets gathered and performance marks. The play is to buy below appraisal or create value through retenanting and water optimization. In practice, that can mean clearing families with weak balance sheets and bringing in large operators who accept higher rent and tighter terms. Crowdfunding platforms push the door open to smaller checks. Own a fraction of a farm, the websites say. The farm becomes a screen of numbers. Acres, tenant, expected cash yield, target IRR. Investors wire $10,000 to a special purpose entity that holds a deed and services a lease. Distributions show up in dashboards. Farm updates arrive like quarterly newsletters from a tech startup. Ownership turns digital. Accountability turns distant. Then come the indices and ETFs. A benchmark is built, often from appraisals, private transactions, and the reported values of public vehicles. And an exchange-traded fund offers daily liquid exposure to farmland performance. Liquidity changes behavior. Price discovery starts happening in the ticker, not the field. A bad crop year doesn't move the ETF much if sentiment stays warm. A rate hike can sink it even when tractors are running and yields are steady. The signal gets noisier, but the money gets faster. Tokenization is the latest layer. A single parcel is split into digital tokens that trade on secondary platforms with near-instant settlement. The narrative promises democratization and liquidity. The reality is that price starts responding to trading dynamics and marketing cycles more than rainfall and crop rotation. Liquidity chases attention. Attention chases news. A viral post about owning a slice of America's heartland can lift tokens even if the tenant just renegotiated rent down after a frost. Underneath all of it sits a simple truth: liquidity changes price. The more ways there are to buy exposure, the more buyers arrive, and the more the last price becomes the next appraisal. That pushes cap rates down. When cap rates fall, the only way to Maintain the same cash-on-cash return is to raise rent or lower costs borne by the tenant. Costs don't vanish, they move. They move into the operator's margin, into input bids, into the rigidity of cropping plans, and eventually into the prices downstream. Fee incentives nudge the system. Management fees are calculated on assets under management. Performance fees clip a share of appreciation. Retenanting or reappraising can lift NAV faster than improving soil organic matter. Leasing to a processor affiliate or layering a solar option can juice other income and freshen slides. Over years, that tilts decision-making toward short-term financial optics. Cover crops become a talking point, not a habit, when a one-year lease renews with a rent escalator and KPI triggers. Diversification, on paper, masks correlation in reality. Almonds and corn don't share a market, but they share water stress and financing costs. A drought ban can dampen cash yields in multiple counties at once. A rate hike can compress valuations across every product that references farmland. The ETF, the REIT, the token, the crowd-funded parcel, they feel different in a brochure. They move together when the macro tide turns. There's a scene that captures the shift. A small operator sits across from a fund asset manager to discuss a lease renewal. The farmer asks for a longer term to justify a cover crop program and a drip upgrade. The manager slides over a template with a 2-year term, a rent ratchet, and performance thresholds tied to yield. It's what our investors expect, he says. The farmer can't finance the upgrade on a 2-year horizon. The land loses a decade of soil health in exchange for a cleaner dividend story. As rates rose in the early 2020s, the slicing met resistance. Borrowing costs climbed and models tightened. Funds responded by turning more parcels, pushing more rent, and experimenting with add-on revenue. Data licenses, water banking, ancillary easements. Products that promised liquidity met a price that didn't bend easily without changing lives on the ground. The story of stability kept playing. The instruments kept trading. But every slice carried the same root dependence. Someone had to farm, in thin margins, on shorter time. And that's the quiet pivot point. When liquidity drives valuation more than yield, the next shock doesn't just mark prices down on screens. It lands in lease renewals, in forced crop choices, and in the aisle where your total goes up before you know why. Interest rates and the new farm debt trap. While products multiplied, one quiet variable reset the math: the price of money. In the low-rate era of the 2010s and early 2020s, farmland felt like a cheat code. You could borrow cheaply against stable collateral, lock in spreads with rent, and let appreciation do the heavy lifting. Debt service barely nibbled at cash flow, and appraisals kept stepping higher, making yesterday's leverage look conservative. That comfort disguised how sensitive the whole stack was to the cost of credit. When rates rose, the first pinch surfaced in margins. Funds rolling short-term debt faced higher coupons. Lines priced off benchmarks reset upward, slicing into dividend coverage. On the ground, that pressure translated straight into the lease. Rent escalators that once felt academic became non-negotiable. Renewal offers came shorter, 1 to 2 years, with higher base rents and CPI adders to protect the model. If a tenant balked, the asset manager called it re-tenanting risk and chased a larger operator who'd accept tighter terms. The balance sheet got relief. The farm's cushion disappeared. Meanwhile, bank lines were built on inflated comps. During the boom, appraisals leaned on sales set by funds bidding with cheap debt. Those prints fed loan-to-value ratios, which fed credit capacity. When rates jumped, those same lenders started stress-testing cash flows against higher debt service. Coverage ratios thinned. Covenants whispered. Advance rates ticked down. Suddenly, land that always comped had to stand on income, not stories. That's where the appraisal contagion began. One lower sale to meet redemptions or debt payoff reset the marker for a whole county. Debt layering made it worse. Farms weren't just collateral for farm operations, they were collateral for everything built on top of them. A fund might secure a revolver against its farmland portfolio, then pledge portions to back mezzanine financing for an acquisition, then carve out a solar option for extra income to cover the blended cost. Each layer assumed liquidity on demand. When borrowing costs rose and exits slowed, those layers tightened like a tourniquet. To free the limb, managers sold parcels fast. Fire sale discounts printed. Local lenders watching those prints adjusted underwriting. Neighbors saw their equity shrink on paper without a single furrow touched. That's the echo of the 1980s farm crisis, playing in a financialized key. Back then, rate hikes crashed land values and wiped out thousands. Today, the mechanics rhyme, but the holders are broader. It isn't just local banks and families, it's pensions, REITs, insurers, and sovereign funds. When they face pressure, they don't call the seed rep, they call the redemption desk. Meeting withdrawals forces sales, even in regions mid-harvest. The selling doesn't ask if a drought just knocked yield or if a water district cut allocations. It hits market and moves the number. Here's how the trap closes on an operator. A tenant signs a 3-year lease in 2021 at a rent that penciled with sub 3% money and moderate input costs. Fertilizer spikes, diesel climbs, rates jump. The fund's debt service bites, and the lease has a CPI kicker. Year 2 rent rises while net price for the crop slips. The farmer asks for relief or a longer term to invest in efficiency. The answer is a shorter renewal at a higher base or a notice to vacate. The farmer leans on a local lender to bridge the gap. That lender is marking down collateral after a nearby sale cleared 12% below last appraisal. The line doesn't stretch. The farmer trims inputs, chases yield, and hopes for rain. One weather miss, and the lease churns. The land doesn't change hands in a deed room. It churns in a spreadsheet. Rate hikes also rerouted capital flows across the portfolio. Money that once chased farmland on the promise of smooth, bond-like returns found actual bonds paying more with less hassle as rates climbed. Open-ended vehicles felt it first. When inflows cooled and some investors asked for cash back, managers raised gates or sold properties. Both options radiated stress. Gating told the market liquidity wasn't what the brochure implied. Selling at a discount established new comps. Either way, the cost of capital got heavier for the next buyer, and rent needed to rise again to make the pro forma hold. Meanwhile, insurers and pensions that had framed farmland as duration hedges found duration risk hiding in the leases. Rising rates cut the present value of appraised income streams just as rent affordability hit a ceiling. The lever left was term, shorten leases so they can be repriced faster. But shorter terms kill long horizon practices that protect yield. Rotation, cover cropping, precision water investments. The soil becomes a quarterly surface, not a generational asset. That trade shows up later in volatility. Fields get riskier as financing demands more stability. Appraisal contagion spread through credit committees. Regional lenders who once leaned on a stack of strong comps saw the top comp turn stale and the freshest one arrive with a distressed footnote. Seller motivated due to fund restructuring. Committees shaved loan-to-value by 5 points and raised rates by 150 basis points. That seeped into operator lines, input financing, and equipment loans. Every notch up in cost tightened decisions. Which acres to plant, which inputs to skip, which field to leave fallow. The aggregate impact wasn't just financial pain. It was production choices made under credit constraints, not agronomy. So who kept belief alive? The same voices that framed land as an inflation hedge rewrote the sermon. Higher rates create disciplined buyers. Long-term scarcity still wins. Conferences and decks refreshed the story with new phrases. Resilient cash yield, drought-adjusted underwriting, water-smart alpha. The narrative reassured the allocators whose capital set the bid. But out past the slides, the rate regime had already changed the rhythm. Money moved slower, leases moved faster, and the gap between a farm's income and its imagined value narrowed the hard way. The trap isn't complicated. Cheap money let financial owners stack leverage on land that produced steady, seasonal income. Expensive money forces that stack to shrink. Shrinking stacks don't absorb risk. They export it, to tenants, to local lenders, to grocery aisles months later. And while sermons steady hands for a quarter, the collection plate is passed downstream.